I want to start by talking about the Fed's problems in unwinding its balance sheet. In the fourth quarter of last year, the Fed bit more than doubled the monetary base. And when I looked back at the St. Louis Fed series on the monetary base, it goes back to 1918, the closest analog was the doubling of the monetary base during World War II that took about 3 years. In this case, the doubling took about 3 months. So it was an extraordinary episode in U.S. monetary history, and the issue is how the Fed is going to unwind from all the money that is created, or central bank money. We have in place the raw material for a rapid increase in the money stock, if you will, a doubling of the money stock in a short period of time. I congratulate the Fed on being very clear about the necessity of unwinding the monetary base or the balance sheet. And I think the Fed has done a good job of explaining the mechanics of this process. I emphasize the mechanics. Little else actually has been discussed by FOMC members in their speeches in recent months. So it's been very transparent, explaining to the public what has to be done. Now, the problem is that the Fed has undertaken to buy mortgage-backed securities, an inherently long-term asset. That program is supposed to be complete unless it's extended and they buy more, to the tune of $1.25 trillion by the end of the first quarter of next year. And mortgage-backed securities are inherently long-term assets. Fed has emphasized that the short-term liquidity programs can be allowed to run off, but they are going to come out by the end of the first quarter with this $1.25 trillion extra on top of the government securities portfolio and the portfolio of agency securities. Now, the Fed's been discussing various ways that it can withdraw some of those funds. One thing that they've been talking about that was in the news just recently is that they can do what are called reverse repos on those mortgage-backed assets. Essentially, the way to view that is that the Fed borrows money from the market using the mortgage-backed securities as collateral for the loan. But it seems very unlikely that the market has the capacity to do repos on $1 trillion worth of mortgage-backed securities. So the Fed is going to have to find a way to neutralize or sterilize the bank excess reserves that have been created through this process. Banks are now sitting on about $900 billion of excess reserves. Those are reserves over and above the percentages of demand deposits that are required in the reserve regulations. This is an asset on commercial bank balance sheets, an asset currently earning an interest rate of 25 basis points. The Fed's been quite clear that one of the things it can do, if there starts to be a great deal of credit creation out of all this cash that's sitting there on bank balance sheets, can raise the interest rate on reserves. But of course, the Fed will have to be raising interest rates, the federal funds target rate, at the same time, and we don't know, we don't have any prior example in post-World War II history of exactly how this process is going to work. What I think, but I don't know, and I don't think there's any way to find out, what I think is the potential here is when you look at business cycle expansions historically, generally a lot of bank credit creation, but the process is constrained by the fact that banks have to go into the market to fund their credit extensions. They have to borrow money in the CD market, certificate of deposit, or at the holding company level. They have to issue commercial paper, and that puts some constraint on the speed with which banks can expand their credit. Now, banks simply have to draw down an asset earning 25 basis points, and at some point it's going to be very attractive to draw down an asset earning 25 basis points and turning it into an asset earning 2 or 3 or 4 percentage points. Car loans, credit card receivables, business loans of various sorts to support inventories, credit to support takeovers, mergers and acquisitions, all the things that banks do. So my guess is that when the time comes that the Fed has to start to rein things in, it may find that it has to raise interest rates much more quickly to keep credit expansion in check. One of the things the Fed has not done, and I think that Charlie Plosser has emphasized the importance of having some rule-like behavior, but the Federal Reserve has not explained, even in sort of hypothetical scenarios, of how it is going to look at the flow of incoming data to make the decisions as to when it has to, so to speak, pull the trigger. Now, as I read the speeches, there are sort of two camps in the Federal Reserve at this point. One camp points to the experience during the Great Depression, where we ended up with a tighter monetary and fiscal policy in 1936 that then created the 1937-38 recession. So this camp says, let's not have a premature tightening of policy. Let's make sure that the business expansion is very well established, and we don't want to cut off the expansion before we get back, is the implication, fairly well back towards full employment. Another camp within the Fed points to the experience in 2003, 2004, when the Fed funds target got down to 1%, and then there was increased starting, I believe it was in June of 2004, at what the Fed called a measured pace, which turned out to be 17 straight meetings where the target rate was increased by 25 basis points at a shot. And many people look back on that, and I don't happen to put myself in that camp actually, but many people look back on that and say rates got too low, they were held there too long, and then was raised too slowly. So they say, let's not create again the risk of another asset price bubble of the sort that we saw with house prices, a runaway mortgage market, of course, with very little equity in a lot of these mortgages, and then the decline in the price of houses triggered widespread defaults that shook many financial firms to their very foundations or beyond, led to the financial distress. So I believe that there are these sort of two broad camps, and as I look at the membership of the FOMC, it doesn't seem to be very many people who are waffling in the middle. Most people who have spoken on this seem to be quite clearly in one camp or the other. But what we need from the Fed at this point is some guidance as to what we would look for. For example, if I were in one camp, my mind ought to be open to be swayed to join the other camp if it looks like the economy is moving along a particular track. And yet, I don't think the Fed is talking enough about how it's going to evaluate the incoming data, the data dependence that Charlie Plosser talked about. Now, Charlie was quite clear that the Fed's credit extensions have really been fiscal policy and not monetary policy. And let me use the example because it's quantitatively the most important of the mortgage-backed securities purchase program. That program actually took some weeks to launch, and I think it would have been highly desirable if the Fed had made its recommendations to Congress to have a legislative authorization for this program. And here's what the nature of the debate might have been. So the Fed recommends to Congress, and presumably they would have be joined by the Treasury in this recommendation, recommends to the Congress that there be authorization to buy $1.25 trillion worth of mortgage-backed securities. And then the question, of course, comes up, well, how are you going to finance it? Well, if it's a fiscal policy, we're going to finance it the old-fashioned way. We're going to issue $1.25 trillion of extra U.S. government debt. And that's a question that should have been asked, but in fact, it was never asked because the Federal Reserve said it was going to do it and create new money in the process, and so the issue never arose. It should have arisen, and the recommendation, which I share, that the Federal Reserve should turn all of those assets over to the Treasury, and the Treasury should issue securities to repay the Federal Reserve, if you will.